Air Canada's net profit in its latest quarter dipping below $200 million, and that was down from $410 million in the same quarter last year. The airline company says it faces a challenging environment. Let's get more from Alessio Di Francesco, Transportation Director at S&P Global Ratings. Alessio, thank you very much indeed for joining us. Air Canada equity down today, the stock down. Investors don't seem thrilled with the latest results.
Yeah, good morning, Andrew. Thanks for having me. The Q2 results that they announced this morning were actually not that bad compared to what we were expecting. The operating earnings were down about 5%, and that largely does reflect the challenges that the company is facing with weaker demand transborder travel, in particular to the U.S., as well as challenges they're facing in the domestic market with increased capacity and higher costs that are difficult to pass through higher airfares. But the company did see pretty strong results in their transatlantic demand, and that's a key market for the company, and is something that we think would still result in flat revenue for this year, despite earnings coming down modestly.
Yeah, it's interesting. You may have touched on this, but the consolidated revenue, and wow, this is such a big carrier, $5.6 billion, and it was actually up around 2% year over year. So the revenue is holding up.
Yeah, the revenue is holding up. It's really the operating costs that are coming up, and we're assuming that if you look at their unit costs for the year, excluding fuel, that'll be up about 5% this year. But the challenge is the airfares, so that it's difficult to increase those in a weaker demand environment. So on a consolidated basis, we think airfares could be down modestly this year, offset by a modest increase in capacity. But overall earnings should be down this year. But even with that, it's worth pointing out that we think that's going to be temporary. And looking beyond this year, the company has pretty good growth opportunity, particularly with the investments that it's going to be making into its fleet to grow capacity, as well as benefit from an improved demand environment beyond this year.
There wasn't a bad jump in cargo revenue, 10% year over year, and it's really the Pacific was the big boost there on the cargo.
Yeah, so they saw some pretty good results on the cargo revenue. And that also, is a good indication that the company is well diversified away from the domestic market, because it does generate more cargo revenue from transatlantic and transpacific traffic that it is able to add to the network.
It sounds like the balance sheet broadly okay. That's certainly the take of Stifel here. Net debt of around $4.76 billion, but the leverage at only around 1.4 times net debt to EBITDA. So it sounds like Bay Street comfortable with the debt load right now.
Yeah, and even when looking at it from a credit risk perspective, that is one of the key strengths that we see for Air Canada. It started the year with net leverage, the way they calculated, about 1.4 times. It was about unchanged in the recent quarter that they reported on. And our expectation is that leverage is going to modestly increase over the next few years, because the company is entering into a pretty significant investment cycle to expand and renew its fleet, and that's going to lead to capex. It's about $3 billion is what they're budgeting for this year, and we're assuming that takes up to $4 to $5 billion annually in 2026 and 2027. That's going to lead to some meaningful free cash flow deficits, in our view, and lead to higher leverage, potentially just over 2 times when looking at the way the company calculates it. But even in that scenario, we still think that they're within the parameters for the existing rating of BB stable, which is what we have at the moment for them.
Yeah, that's interesting. The jump in capex, again, just working off Stifel's report this morning. Stifel reckons this year the capex will be about $3 billion, but that's going to go to $4.3 billion next year, and then almost $4.7 billion the following year, $4.6 billion. So that will that be a thing that will worry the market, that surge in capex, or will investors look past that?
I mean, from a credit risk perspective, it is something that we are watching and monitoring because one thing that those significant capital commitments do is it reduces the financial flexibility for the company in the event that earnings meaningfully decline from what we're anticipating. So if we see a severe recession or just meaningful decline in macroeconomic conditions that lead to weaker earnings and cash flows, there's less of an ability for the company to respond and protect the balance sheet in that scenario. But it does help that they are starting the year with a net leverage of 1.4 times. So that is a low leverage for the rating, the way we look at it. And so it does provide them some meaningful capacity to manage through this temporary period of increased investment. And if everything plays out the way the company would like, they could be in a position in 2028 when capex levels come down. They'll be generating some pretty meaningful free cash flow that they can use to repurchase shares and maintain their longer-term net leverage targets at or below 2 times.
Yeah, so your rating is fairly low on Air Canada right now, BB, so that is sub-investment grade. We're tight for time, but what could prompt an upgrade, Alessio, do you think?
An upgrade, the way we look at it, an upgrade would require meaningfully lower leverage. We have it pointing to adjusted funds from operations to debt above 45%. Which implies a net leverage under the company's methodology that is less than what they're targeting. So it doesn't seem likely over the next 12 months, particularly given the significant investment and the less financial flexibility that I mentioned earlier over the next couple of years. But there could be more upward pressure on the rating later on if we do see this investment completed and just better prospects regarding their margin improvements over the next couple of years.